One of the biggest questions, I get when we're starting to work with a couple is how are we going to withdraw this money? Like, like practically, where is this money going to come from, and how should we pull it? So today, I'm going to walk through though answering those specific questions. I'm Derrick Alexander with Greater Works Wealth. We specialize in helping people with intergenerational planning. That's a fancy way to say is we like working with the parents and the children to help connect their financial lives and households, truly creating a a comprehensive financial plan that helps cater to both generations. Okay, now hopping into our withdrawal strategies, and how should we look at taking withdrawals from our various different accounts. The first thing that we need to cover is where do we think our tax rates are going to be in the future? Okay. Uh, we really need to know, do we think our tax rates are going to be higher today than they will be tomorrow? Will they be about the same, or will they be lower today and higher in later years? And that'll kind of set the foundation around where do we want to pull these dollars from. Okay, so let's start with the first one. If our taxes are actually going to be higher today than they will be in later years, then what that may entail is us taking a look at, does it make sense for us to start pulling from maybe like our Roth buckets first, because we're going to have higher tax years earlier on. And what that may allow us to do is use our tax free dollars, bring down the amount we're going to pay in taxes earlier on when we're expecting to pay more. Then in those later years, we start using maybe those funds like our traditional IRA dollars that are going to be taxed at a much more favorable rate. Um, the way I kind of like to explain it is, will we rather, at least when we're looking at our pre-tax dollars, will we rather lose, 30 cents on the dollar today or pay 15 cents on the dollar tomorrow? Now let's look at the situation. If our taxes aren't going to necessarily change that much, generally what we'd like to do is probably start with taking funds from sources that may receive a little bit more favorable tax benefit, but maybe not start with a Roth IRA. Where are those accounts where we may get taxed at long-term capital gains, which may be like our brokerage accounts, or maybe we have a concentrated stock position, or is those accounts where we're not necessarily getting taxed at ordinary tax rates, so we don't have to worry about getting bumped into that next tax bracket if something were to change or life events occur. But we're kind of maintaining the status quo. And then in the future, we may start looking at, hey, here's our traditional IRA and our Roth dollars. One big thing that I think is important to take a look at is requirement on distributions. In that type of scenario, does it make sense to pull funds from our individual accounts, or brokerage accounts earlier on, and then maybe in that process do some Roth conversions throughout that time to be able to control our tax rate and then minimize our tax rate moving forward in the later years. So that'd be something to take a look at. And then our third option is, if taxes are lower today and higher later on, the strategy we may look at is, if the taxes are lower today and we're going to get the lowest that we're going to get, it may make sense to start pulling from our traditional IRA, those pre-tax dollars today, where we may pay 15 cents on the dollar. And that's an simplification of how to think about it. But it's kind of the same theory. Do we want to pay 15 cents on the dollar today and pay 30 cents on the dollar tomorrow? If that's the case, let's pay the 15 cents on the dollar today. And then what we'll do is later on in those years, we'll allow those tax free dollars to continue to grow in our Roth IRA, and then pull on those funds at that point in time. I think there's some miscellaneous kind of specialized options to take a look at in regards to, like, if you have medical expenses, if you have a health savings account or HSA, we may want to prioritize using funds from that account. If you, for some reason, you have any excuse me, educational expenses that may be coming up, maybe utilizing like a 529 or something, or if you're wanting to pay for something for your grandkids or nieces or nephews, that's something that we could look at doing. And the reason why that is, for your health savings account, if we're needing medical expenses, you're getting a triple net tax savings. One, you were able to put it in there tax deductible, it grew tax deferred, and if it's used for max for medical expenses, you get to use it tax free. Okay. With the 529 plan, it may be a little bit of the same, depending on the state that you're in. If you're using like a state run 529 plan, sometimes you can get a state tax deduction, and then you don't get taxed on the growth in that account. And then if it's used for education, you can utilize that money tax free. But hope you found this helpful. If you ever have any questions, or you're in one of those situations where you're looking at potentially retiring, but you don't know you don't know if you have enough money, or you think that you do, or you want to confirm those numbers, and you're just looking to gain some clarity around your situation. And you'd also like to connect this plan to your second generation. Uh, we'd love to hear from you. And feel free to reach out to us for our free retirement strategy session. Look forward to talking to you soon.